Hey there. In the last video, we've worked on 4 adjusting entries. And let's continue and finish the cases. Okay, the next case is in the textbook is in October, the firm performed services. Oh, you are by now familiar with this term. Service performed should by this time, by now, automatically remind you of the revenue. Right? The firm is entitled to recognize revenue worth 200 that will not billed before October 31st. What does that mean? You didn't bill it, so you didn't receive cash, but you are entitled to recognize the sales or sales revenue. I told you that in this class we are using sales and revenue interchangeably, although in theory the two are a little bit different, but not a big deal. Okay, so sales you can recognize, and as you saw here, they are usually credited 200, and they are not billed yet, meaning you didn't receive cash, therefore it should be yes, accounts receivable on asset item, right? The money that you will receive soon from your customers. And then number 8, on the next case, the firm signed a 3-month note payable in the amount of 5,000 on October 1st. Do you remember this case? I do. Here, equipment, 5,000, notes payable, right? And you remember that I told you, please ignore this part, right? Interest. It is an important part, but I told you to ignore it. What's up? Because interest is going to be recorded as part of adjusting entries, chapter 3. Now, let's talk about that. Interest. And I usually, I tend to describe interest as time value of money. What's that? Interest. Why should you pay interest to banks when you borrow money from them? Let's say that you borrowed money, $1,000 from the bank. Then what's the cost of banks from banks' perspective? Nothing? Right. No. The cost is, from banks' perspective, they may have lended the money or they have used the money for other purposes, right? Like, let's say that they used the money to lend the money to me. Then I am a high return person and I can give them much more money than the interest you pay. As an example, silly example, you know, right? That is, there is some opportunity cost from bank's perspective, right? Meaning, as time goes by, the bank is losing that opportunity cost, right? Accumulating that opportunity cost because the bank chose you. The bank decided to lend money to you, for you, right? So as time goes by, tick, 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 the opportunity cost is being accumulating, which means as time goes by, tick, 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 you are supposed to pay money, the interest to the bank every single second. Do you do that? No, not realistic at all, right? What you do in the real world is you pay interest, in this case, at the end of the 3 months, right? At the end of the 3 months of maturity, you pay the principal 5,000 together with the interest 12% times 5,000, right? At the end of the 3 months, when is it? Yes, February 1st, right? Sorry about that. What am I saying? I'm crazy, right? At the end of 3 months period from October 1st, then what's the date? January 1st, right? What's the date today? October 31st. Do you pay interest today, October 31st? No, you pay interest January 1st, right? There is no cash transaction involved here. But what did I tell you? Interest is time value of money. Every single second you are supposed to pay interest, right? You didn't pay. Then would you say that there's nothing for me to do? No. We are living in the world of accruals accounting, right? Even though you didn't pay cash yet, you are supposed to pay, you are supposed to expense your interest. And did you pay cash? I'm asking you again. No, you didn't pay cash, but you are supposed to pay, right? Therefore, you owe to the bank the interest to be paid. That kind of liability is called payable. In this case, interest payable. Okay, how much is it? Again, interest is to the principal 12%, 0.12, right? But please note that interest rate is annual rate. Believe me, in most of the business cases, the percentages are, in most of cases, they are annualized terms. Unless it is, specified. If there is no terms specified, then consider it as an annualized term percentage. Okay? Okay, annually 12%. Then for a month, yeah, we are talking about just 1 month, right? How much is it? It is just 1 out of 12, right? Would you pay 12%? No, that's not fair, right? We are talking about just 1 month. So you will consider only 1 out of 12 of the 12%, which is actually 1%, right? Okay. Finally, salaries. Okay, cool. I like salaries, right? Salary was paid meaning cashed out, right? October 26. What's the date today? Again, today is October 31st. Next payday is November 9th. All right. What's the date today? October 31st. Is today payday? No. So there is no cash transaction. So you don't have to do nothing. No, man. We are talking about adjusting entries. Even though there is no cash transaction, you should pay some, you should record something. That's what we are talking about. Okay, then what should you record? Can you guess? Yes, as you can guess, we are talking about salaries and wages expense. Okay. Daily wage rate is 400. 3 business days are left during October. What does that mean? At the end of October 31st, you owe to your employees 3 days amount of wage, right? What's the assumption? Ideally, every single second as your employee works, you should pay salary. Ideally, but is it possible? No, right? That's the reason why most of companies pay salaries once a month or twice a month, something like that, right? The same. In this company's case, it appears that they are paying again twice a month, right? And 3 business days are left in October, meaning between October 27th and October 31st, 3 days your workers worked, but you didn't pay cash. Therefore, you owe to them. You owe how much? 400 daily wage rate for 3 days, right? Okay, we are done with the journal entry, adjusting entries. Then, shall we continue preparing the general ledger accounts? Okay, what shall we do? First, supplies expense. I don't think we'd had supplies expense account. Cool, let's create one. Create one. Debit, right? And we have supplies expense. All right. Then next line is supplies. Do we have it? I think we had it, right? Supplies. So let's make a line for supplies, right? Where is it? A1, right? A1 supplies for the date, this date, you credited it, right? And the ending balance is gonna be from the beginning balance, you add debit sides, right? From the beginning balance, you add debit sides and you subtract out credit sides, which leaves you nothing. Seriously? Something's wrong, right? Again, October 31st balance is not 2,500. Why did I type in 2,500? It is 1,500. Okay. Okay, then we are done up to here. Let's move on to insurance expense. Did we have it here? I don't think so. So let's create a new one. Insurance expense. Okay, date here and debit side, meaning. Okay, then prepaid insurance. Did we have it? Yes, we had it. So let's insert a line and prepaid insurance for date, this date, and for the balance 50. I know now why a wrong number was typed in. I copied and pasted. Then what's pasted is the formula, right? When I want, what I want is this value. Right? Okay. Then again, from the beginning balance, you add debit and subtract credit because it's an asset item. Right. Then you see a depreciation expense. Okay, depreciation expense is also new. So I will write down the numbers here. Accumulate depreciation is also a new item. So I will post the numbers onto here. unearned revenue. I think we had it, right? There it is. So let's make a line for unearned revenue. Let's make a line for unearned revenue. And A4, unearned revenue, date, and 400. Oh, 400 is debited, right? This is a liability item, so its normal balance is credit side, right? To the beginning balance, you add up credit side and subtract the debit side. And your unearned revenue balance becomes 800. Make sense, right? You initially recorded your liability 1200. But as of October 31st, you recognize that it's not 1200 anymore. We've earned 400. Yes. So our debt, the unearned revenue debt balance is now not 1200, but 800. Yes, 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 yes. Now the next line is sales. Did we have sales account? I think we do. Yeah, here it is, sales, right? So let's make lines. I think we need to make 2 lines, right? You have 2 sales, right? Again, one is A4, this date, right? And 400 on the, what am I doing? 400 here, right? So sales, where is its normal balance? Yes, credit side. So to the initial balance, you add credit, subtract debit, right? Then next sales is here, the same date, and it's 200, right? You copy and paste, so we can say that the first sales was 10,000. You add up 400 and 200 and end up having sales 10,600. Cool. And then interest expense. I think this is a new item. Interest expense of 50 as debit side. Okay. Next is interest payable. It's new also. So we keep copy and paste. And salaries expense, is it new? No, we had it before, right? So we will shift down everything and then 10/31st, the amount 1200. Oh, not 1200. Its beginning balance is 4,000. To the beginning balance, it's an expense item. Its normal balance is debit side. So you add debit sides and subtract credit sides. End up your total salaries and wages expense is 4,000 plus 1,200, which is 5,200. Cool. Finally, we have one payable item. Salaries and wages payable, the date, and then the balance is 1,200. Right? Oh, we make on small indents for credit sides. Yay, we've completed all adjusting entries and we posted the adjusting entries onto the general ledger. Okay, in the next video, we will have a look at the preparation of the trial balance. Now we will retitle the trial balance as adjusted trial